consider a professional setting, it's important to understand your organization's financial situation. That can be very easily learned through understanding the reports within your organization, reading up more on the situation, on the stock market, for instance. A simple way to understand your employer's financial situation is by reading up on their financial statements. There are three types of financial statements that you need to understand and identify. These include the income statement, also known as profit and loss sheet, the balance sheet, and the cash flow statement. Business finance is about understanding how corporations and businesses work. Regardless of whether you work for a business, or if you own a business, or if you play a smaller role, this kind of information helps you understand how the world works. This knowledge would allow you to develop vision towards the future. An important aspect to understand when it comes to business finance is that it is first and foremost built on financial performance. Furthermore, it is also measured by the assets and liabilities. Here's where accountants come into play. Ultimately, this information is reported through financial statements, which we'll delve into detail in a few minutes. The factors that impact financial performance of any business or organization are the backbone of any business, which are the assets and the liabilities. It's important to understand how asset utilization versus its depreciation comes into play. But of course, the external impact of any business is its sales. What goes hand in hand with sales? It's the receivables. Making and closing a sale is important, but the receivables behind those sales, meaning receiving that money from the sale, is even more critical to a business. Hence, sales being the first point listed here. Of course, inventory management is something people swear by. If not effectively done, it could destroy a business. Ultimately, return on investments that were made, which includes inventory, and capital expenditure are also very critical. Capital expenditure relates to the funds that an organization utilizes in order to manage all of the organization's physical assets. Now, going back to that first point that was listed, which is the external view of business, sales. Sales work through budgeting, and there are multiple aspects to consider. But the two more important ones when it comes to defining sales budgets are the variables as well as the terminology. The variables behind sales budgets include the purpose behind a financial target that is set, of course, always the time frame, as well as things that impact the financial equations, which is a point that we'll be talking about in a minute or two. In terms of terminology, there are different terms that are bounced around when it comes to sales budgets. Not just the word budget, but also what is a forecast? And with that, does it also mean projection? These three terms are often incorrectly interchangeable. A budget is more of a fixed figure when creating a financial plan for your sales. It is a target that is set for sales. In contrast, a forecast is an anticipation, which is estimated based on the current information that we have in real time. Similarly, projection is also an estimate. However, it is impacted by specifics, meaning certain hypothetical scenarios, such as changes in the economy, new customers that were gained, and so on and so forth. This takes us into the equations which impact business. Now, when it comes to equations, there are certain elements that are impacted based on accounting and others based on finance. But what's the difference? Aren't they kind of interchangeable as terms? Not at all. Accounting has to do with keeping track of figures, whereas finance uses the practical information from that tracking exercise to increase revenue. 3 equations that finance is based upon are profit, revenue, and cost. These are the variables that impact your sales. Taking us back to the backbone of business, which are the assets and liabilities, these are the variables that are of concern to accounting. Beyond these 2 terms, another aspect that is of concern to accountants is the equity, or the perceived value that shareholders view, hence assets being the addition of liabilities with that perceived value or equity. But ultimately, the true measure is assets and liability ratio. Business finance is gauged through financial statements that are being reported. This takes us back to the 3 financial statements of a business, starting with the income statement, also known as the profit and loss sheet. The income statement provides a visual based on a period of time of the results of your financial performance. Your income statement is the visual of that equation of revenue. Next is the balance sheet. The balance sheet is a valuable statement for accountants, hence capturing the worth of a company based on shareholders' equity, which equates to assets minus liabilities. The difference between the balance sheet and the income statement are that the balance sheet is a snapshot at a particular point in time, as opposed to a trend over a period of time. Finally, the cash flow statement. Now, the cash flow statement is what you would look at to take a look at the health of an organization. The cash flow statement gives us a true indication of the available money an organization has access to. A negative or unhealthy cash flow statement indicates a business that is not going to be able to sustain itself. This is regardless of profitability. A cash flow statement looks at things like how much it takes to operate a business, how much of an investment is required, what kind of financing is required, and of course there's a visual for short-term and for long-term. Ultimately, the success of a business would be based on healthy statements when it comes to the balance sheet, the income statement, as well as the cash flow statement.